Hello, my dear students. Hello, my dear friends. Today we are going to discuss about investment options. Multiple options are there nowadays. We know that the investment industry has become dynamic. We are not confined only to few or options or few alternatives where to invest our money. And not only that, because we have to invest seeking long-term benefits, we have to understand which all platforms, which all avenues, which all options are available where one can put money. So, if you are a student, you might be having some pocket money. If you are a person who is doing job, you might be having a good amount to save. If you are doing business, maybe yearly or maybe every 6 months, sometimes you are getting some money which you can put for investment. So we have different avenues where we can put our money, and we are going to discuss those briefly. So let us start with the following chart. Now, if you look at this particular chart, I'll just take you quickly on to these particular presentation. If you see the parameter is the base on which we are going to analyze different sort of investments. So if I focus on first, most commonly known as fixed deposits, which we can put in our banks or post offices. Second is the stocks, that is the equity market. There are different stock exchanges worldwide which are prevailing. Through that, we can directly deposit our money. We can invest our money with different companies in equities. Third is mutual funds. Then we can have commodities market like gold, silver, platinum, copper, whatever. And then commodities, different type of commodities where we can invest our money. Now, one approach is that invest in anyone and forget. Like earlier, people used to buy gold only, or they used to put money in fixed deposits. But nowadays, it has become a part of diversification, and we are having an opportunity to invest money in multiple avenues at the same time. Like we can call it proportionate investing, that we can invest the money proportionately in different avenues. But what are the basis of comparison? What is the basis of comparison? Like number first is risk level. See, whenever you are putting money in bank also, when it is called that banks are also not safe, because there is a risk associated with the banking, their own governances, and in the past we have seen some sort of problems. So I will not go in depth, but understand. Risk level very low. When you put money in your bank in fixed deposits, the risk is very low. That means we have a faith that our money will not be stolen, my money will not be destroyed, my money is going to be safe. So it says the principal usually guaranteed by the bank institution. Means if you have invested 1 million, that 1 million is considered to be safe. If you have deposited 50,000, that means 50,000 is going to be safe. We are considering that. We are not guaranteeing that, but it is a guarantee that principal is safe. In stocks, this risk is very high. I will not say high only, I will say very high. Very high means because it totally depends upon the functioning of the companies where you're going to invest the money. So ultimately, whatever money you're going to invest in those companies, if the company progresses, your money progresses and grows. If the company goes down, if the company does not grow, if the company shows negative results, your money is also going to go down. So the risk is high. It depends totally upon the market volatilities and company's risk. Moderation too high. Mutual funds, basically, if you remember, if you understand that mutual funds are basically when we are putting money into stock market, means this mutual fund they invest in stock market only, but not directly. We are not putting money directly in stock market. We are putting money through mutual funds. So there are so many mutual funds are available. So definitely when we are using their expertise, their professional understanding, they try to reduce our risk. So our risk goes from high to moderate, right? Not very high risk, because ultimately it is a stock market only, but our risk get diversified. So it depends upon type, equity, debt, hybrid, which type of mutual funds we are investing into. Then gold is like precious metal. It is a moderate risk, not very high, not very less. Price driven by macro factors, less volatile than many commodities. If you ever see on the Google, if you just search in the past behavior of the gold prices, you will see Over a last period of 20 years, the price of gold has always beaten inflation in many developed countries because the price is getting affected by the macro factors and the risk is getting lowered. In commodities, if we talk about commodities, it is very sensitive to global supply and demand, geographic weathers, geopolitical things, and all other things like commodities, like what you're eating in your food, like pulses, like your grains, whatever it comes in commodities. So all these things are actually depend upon these things. But as a normal person to invest in the market or invest or save money, you can consider these four as a base for your investment. Now, one thing we call it a risk-free investment. Risk-free means there is no risk to put money into bank FD. I want some risk, go to mutual funds. I want high risk, go to stock market directly. So these are different avenues. Return potential. Who can give you more return? Now, always remember, higher the risk, higher the chances of getting more return. There is no guarantee of more return. Higher the risk, higher the chances of getting more return. So it says in fixed deposit, the returns are fixed. There is no guarantee of more returns. If your bank is giving you 7% return, you will get 7%. If your bank is giving you 2% return, you will get 2%. If your bank says only 1% return, only 1%. But in stock market, what can happen? Because you are taking a high risk, there are chances that you will be getting very high potential over the long term. Please focus on this word. We are talking about long term investing. We are not talking about short term investing in here. In mutual funds also, it is high. Returns are of course fairly high, especially equity and mutual funds, or moderate for debt fund. If you are putting money into equity funds, means companies and sectors, then your returns are going to be fairly high. But if we talk about debt funds like government securities, money market funds and all, your return is going to be moderate, not very high. Historically strong like gold, as we discussed in the last 20 years, historically gold has given very high returns. So gold has had long term returns but more stable, risk adjusted than many commodities. Many investors, when they are putting money into stock market, they always buy 30 to 40% of their money in gold. They invest in gold also to stabilize their returns. If whenever the market will go down, the gold price will go up. Whenever the market will go up, gold price will not go down, it will get stabilized. That is the best part for hedging of the funds. You will know about this word later on if you want to search about in the internet also. Volatility means up movement and down movement. Volatility means risk, like kind of risk is very low. In bank, if you see, it is very low. There is no volatility, there is no high, it is not impacted by your demand and supply functions. It is directly you are putting money in bank and bank is giving you 2%, 3%, 7%, 8%, whatever. So it is not volatile. But in stock market, the volatility is very high because subject to market swings, sentiments, business cycles, the returns can be high, returns can be low. Today, the same company has given you 20% return. Tomorrow, next day, or next month, this company can give you return of 5%. And sometimes this can go to negative returns also. So, volatility is very high. But this volatility is kind of adjusted by mutual funds. So, it calls for like it varies. The volatility in mutual fund varies. Equity mutual funds, high volatility. Debt mutual funds are less or so. The volatility in case of debt mutual fund is less. Volatility in case of equity mutual fund is very high. Now, in terms of gold, because it is considered as a stable investment, it is less volatile than many commodities. Gold risk per unit has historically been relatively lower. The risk in gold is always lower. I'm not covering major part of commodity market like oil, metals, iron, steel. There also we can invest through stock market in particular companies also. Now coming to liquidity. The fourth parameter is where should I put my money that I can take out immediately if I need. See, if you are putting your money into bank for fixed deposits and you want to take it and you have deposited your money for 2 years, and you want to take your money out after 6 months. So the liquidity is okay, but what will happen? You will be penalized. There will be some penalty imposed by the bank, as written here. You will be penalized if you take a early withdrawal. I want to take my money back. Okay, take it. You will have penalized. The penalty will be imposed upon the depositor. In stock market, high liquidity means today morning you want to sell. In the evening you want to sell. Today you have bought, tomorrow you want to sell. Now I have bought, after 2 hours I want to sell. Means, but there is no guarantee of that you will get more returns. Whatever is the market price and you want to take your money out, depend upon whether you have earned money or you have lost some money. That will depend upon that. Your money can be liquidated immediately. Same goes for mutual funds. In mutual fund, you can sell your units. You can liquidate your mutual fund units as and when you want during the trading hours. In gold also, it is high. You can go to the jewelry showrooms and just sell your gold ornament, whatever ornaments you have, gold biscuits you have, gold coins you have. You can go to the gold merchants and they can easily buy it at the market price. Inflation hedge. Now see, you know that every country is facing inflation. The price of the commodities, price of the things are getting increased day by day. So in that case, it is always like that fixed deposit in bank can never defeat inflation. The fixed deposit are never showing that result that it will take care of our inflation also. So we always say it is a poor to moderate. So can my fixed deposit take care of inflation? The answer is almost no. When it comes to the stock market, if you are putting your money for long term, then average return what we get in stock market in the stocks can definitely give you inflation control moderately. I will not say very high. Same goes with mutual funds. It can be good and very good for gold. As I am telling you again, gold investment is considered like hedging against risk of inflation. So whenever there is a high inflation, the price of gold increases. Always remember, because it is not a normal commodity. It is like a precious metal. Whenever there is inflation, price of gold will increase. Whenever there is a stock market crash, price of gold will increase. So whenever there is a war between geopolitical problems in the countries, gold price will increase because it is considered as one of the reserves by all the bankers in the world. Correlation with the stocks, like, is my fixed deposit linked with stock market? The answer is no. There is no correlation because today you are investing money for 2%, then you will get 2% only. Even if the stock market goes up or down, there is no correlation. Stock market itself not applicable. How can I compare myself with myself? His answer is no, not applicable. This is the base because we are taking stock market as the base. Now, if stock market goes up, mutual fund price will also go up. If stock market will go down, mutual fund unit price will also go down. So that definitely varies depending upon the fund type. Equity fund, correlation more, debt less. If you are putting in equity market, there is a direct correlation. If you are putting in debt market, there is less correlation. Correlation of gold to stock market. Gold often acts as a diversifier, especially in the crisis. Whenever there is a crisis, gold is always coming like a safeguard, right? Now, ease of investing in complexity. Nowadays, everything is easy. Now, there is nothing like you cannot invest in stock market easily, or you cannot put your fixed deposit easily, and everything is coming through financial technology. Online, we can do everything. It says, in case of fixed deposit, it is very simple. In case of stocks, it requires some knowledge or can be passive via ETFs. Means ETF, forget about ETF, let's just focus upon. Nowadays, we are using mobile applications to invest in stock market. Also, mutual funds. Nowadays, very easy for SIP or index fund. As we know about SIP, SIP, like systematic investment plans. We can do such things easily. We can easily do it through our apps, through our websites, through our concerned mutual fund websites. Easily you can invest in mutual funds. Ease of investing, it is easy, not complex. Fairly easy via ETF or digital gold. Physical requires storage security. See, nowadays people are not only buying physical gold, they are also buying gold through stock market. In stock market, there is a traded fund. We call it ETF, exchange traded fund, where people are putting money in those trading funds which are investing in gold. So you can buy gold directly also from those particular ETFs. Now, cost. Nothing is free in this world. I always say that nothing is free in this world. Even free world is not free in this world. If you go to any mall anywhere, you say free Wi-Fi. This is not free Wi-Fi. You are going to buy something and they are going to compensate your this particular. There, it's an investment in you. You are using the Wi-Fi, but it's not free. You are buying something against that. So now cost. If you put money in bank, they have some charges. Very low charges are there. Bank may charge little or no commission, because ultimately the business of bank is to take money from you and give lending or take deposits and lend to the borrowers. So whatever money you deposit, it is a like wow, they are getting money to lend it to somebody to get more returns. So they are giving you 2%, they are getting 5%. So 3% is their commission in between charges, the profit. Out of 3, they will spend their money for expenditures and any other things. Then they will get some money for profit. In stock market, we have brokerage fees. Many countries, different countries have different charges. Like in India, if you have seen, the charges are around 20 rupees also for delivery, for intraday, sorry, for delivery 2%. And in other countries, if you go, like in Oman, if I talk about Oman country, it is 3.5% plus VAT. Like these are the different charges, like 0.35, like 0.35 per thousand is the charges for Oman. Expense ratio for funds, some exit loads. In Oman, in many countries now there is no entry load in mutual funds, but still in many countries there are entry load. Means when you buy units, you have to pay entry load. When you say buy, I'm selling my units. Again, that time you have to pay exit load. Cost of storage for physical. See, buying gold is very attractive. Physical gold, ornaments, biscuit, coins, whatever. But keeping them in a security in a locker is very expensive. You have to be very careful. Where if you are blessed and you are in any country where you are not having a fear of getting it stolen, it's good. But many countries, it's a very risky to keep gold physically in your house, because you never know, somebody is having eye on you and it is getting stolen by somebody. So otherwise, if you are buying online gold through ETF, exchange traded funds, then you have to pay expense ratio like mutual funds. So the summary is, if you talk about the different avenues, FDs are the safest among these options, but their return potentially is limited. They suit conservative investors or for funds you don't want to risk. So means you don't want to risk your money, so put your money into bank. Stocks, they offer the highest upside if you are willing to accept volatility. Means you are ready for those fluctuations which are there in the market, in up and down, like movements are there. You cannot depend upon one line. It can go down also, up also, but in long term, we have seen the trend. In long term, people tend to get more returns. Good for long term goals. It is never meant for short term. Stocks are meant for long term goals, not for short term. Mutual fund also in the same category. They are flexible way to get exposure to stocks without picking individual companies. You're not picking one company, you're picking one mutual fund, and that mutual fund can invest in multiple companies. And they also give you diversification. Gold, as I told you, that this is a weapon against inflation or hedging. While being a commodity is often treated separately because of its unique role, it is proven store of value. It tends to do well in economic uncertainties and has lower volatility compared to many commodities. Because gold is also a commodity, it's like a metal, but it's a precious metal. Silver is also a metal, it's also but precious metal. Commodities, they can provide strong hedging value and return potentially, but they are complex. Prices depends upon supply and demand shocks. For example, geopolitical events affecting oils, and there is a risk of losses due to futures role, leverages, etc. If you don't understand this last two words, no need to get into that mind that okay, how will I understand this? No need to understand. Just forget about it. Focus on only on these criterias, that there are mainly four different avenues of investment. One is fixed deposit, stocks, mutual funds, or gold. And all these features we have to take into consideration when we want to invest in one, some, or all proportionately. If you have 100, you cannot invest all 100 in one. Rather, there is a statement called do not put all your eggs in single basket. This is a financial jargon phrase which is used worldwide. Now, if I talk about the returns, now I'm giving you one small exercise to understand. Normally, if you talk about the returns, normally the bank's return will vary from 4 to 7%. I can say 4 to 7%. In stock market, the returns can vary from 15 to 20% in long term. So let us say 20%. Let us say here 4%. In mutual fund, we can expect, let's say 12%. In gold, we can expect 10%. Commodities, let us leave it now. Let us leave it for now. So if I ask you that in which commodity my money can grow faster, in which particular investment option my money can grow faster, definitely if you look at 4 to 7%, 15 to 20%, 12%, 10%, definitely in stock market my money can grow faster, but subject to risk. So consider all this. Somewhere you have risk, somewhere you have returns, somewhere you have both, somewhere there is a correlation, there is no correlation. Accordingly, plan to invest in one, some, or all the avenues proportionately. All right. So that is all about understanding different avenues and their parameters of comparison for investment. And since you all are growing well, so you have to invest somewhere now or tomorrow. So all the best. Keep learning and keep investing. Bye bye.